Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Caitlin Cormier. If you're relatively new to investing, you may have figured out that it's more an art than a science. After all, no two investors are exactly alike in their financial circumstances, needs, and goals. That means there's no formula to follow that's guaranteed to result in financial success per se. And for some, that can make investing a little intimidating. But fear not, there are many common experiences that investors tend to share, and the lessons learned by others can serve as a guiding light for those still finding their way. Our guest speaker has spoken to dozens of savvy financial professionals and investors on her podcast, and she's here to share some of the top investing lessons that she feels can help those just starting out. Joining us is Tracey Bissett, founder of Bissett Financial Fitness and host of the Young Money podcast. Tracey, it's great to have you on the show. Thanks so much for stopping by.
No, thank you, Caitlin. It's my absolute pleasure to be here, and I'm excited for our conversation.
Fun fact that we learned out, we actually grew up like 500 meters away from one another in Cole Harbour, Nova Scotia. A couple famous hockey players from this area as well, and then you and I. So there we go. You recently celebrated the 300th episode of your podcast, Young Money. Congratulations. That's an incredible milestone. What inspired you to start the podcast?
Well, throughout my whole life, I've known, growing up with a dad who was a banker, parents who were really fiscally responsible, that money was kind of the key to how your life can go. And so I've always been passionate about learning about money, and then wherever possible, helping others learn about money. So I took the opportunity when I was transitioning from a corporate career into do some teaching and financial coaching to start the Young Money podcast, so that I could put out stuff I would have liked to know and really make things simple and clear for everybody so they can learn in bite-sized chunks. And it's been going strong since 2017, and I'm really proud of the body of work that we've been able to put out there, and the amazing guests we've had on the show, and the great reviews that we get.
Yeah, so speaking of that, what sort of memorable feedback have you had from your listeners over the years? I can imagine that a lot of them have reached out. This is such an area that I feel we don't have enough, knowledge in school and the, curriculum in schools and that sort of thing for people to learn. So what sort of feedback have you heard from listeners over the years?
So one nice piece of feedback I get regularly from people I used to work with in banking is that they learn something new, which I always take as a compliment because everything is always evolving. So I'm always learning new things, and it's great that somebody who's in the industry is learning something new. I love as well when I hear from our young listeners that they say something was easy to understand, and they actually got some practical, tangible tips that they could implement. So it wasn't just an academic lesson, but that they could actually go ahead and do something, and they felt more confident taking action. Because with anything financially related, it's about taking that first step and keeping up with smaller steps. It's not about one big sweeping action or behavior. It's about all those incremental small steps that you got to take.
Absolutely. It's what you're in it for, to help empower people to kind of take that next step and get going. That's amazing. Okay, let's get into our conversation. Tracey, you're a big proponent of what you call financial fitness. So what exactly does that mean, and what does it take to become financially fit?
I'm glad you asked that question. I get it quite often. And usually when we're talking about financial matters, we're talking about financial literacy. And automatically when someone hears that, it almost puts them back on their heels. They're feeling really defensive, and all of a sudden people become illiterate. And that's really not the intent. There's already a lot of shame around money, and people have difficulty talking about it. So if we think of it akin to physical fitness, we might be taking that first step off the couch and we're going to walk around the block, or we could be training for a marathon. So we're improving our physical fitness. Same thing akin in our financial fitness. We could be just learning about different kinds of savings accounts, or we could be training to become a more sophisticated investor. And everyone's at a different place on their financial fitness journey. Generally, we move forward on it, but we can have side steps. We can come back a little bit, and lives are very unpredictable. So I like people to think about it as, what is the one thing I can do today that's tangible, move me ahead? I also like everyone to be reminded that everyone makes mistakes. Nobody's perfect. And so we want to think about what can we do to continue on the journey without beating ourselves up if we do happen to make a misstep. And certainly investors and others who are involved in their financial lives are looking for those tangible things that they can do to move themselves forward.
I love that. I love the way that you relate that to fitness versus, like you said, there's a lot of stigma around financial literacy and people feeling like they can't partake in it, and then just, being out of the conversation completely. So yeah, I absolutely love that parallel. I think that's great. That's a great parallel. So you've spoke with dozens of financial professionals and experienced DIY investors on your podcast to help your listeners get their personal finances in shape. So let's chat through some of the top lessons you've heard from your guest speakers. The first one that comes up from Leanne Hawkins of Blackhawk Finance in episode 106, and that's to validate investing tips from social media influencers. So why is this so important?
Well, people are consuming so much social media these days, and they're not necessarily turning to structured news, credible news sources. And I'm not suggesting that influencers are not credible, but I think, again, we need to be checking our assumptions. We need to use some critical thinking. If somebody was selling makeup 2 weeks ago, last week was vacation packages, and now this week they're going to be promoting a trading platform, we want to do a little bit of due diligence and start asking ourselves, does this person have any expertise to actually provide this advice? Or are they simply being paid to do an advertisement on something maybe they have no knowledge? And so we'd want to do a little bit of digging to find out, are there any credentials associated with this person? Do they have any experience with this? And then go a little bit deeper and maybe look for some reviews if it's a product that we can actually hear what other people have to say about it, and check it from other sources as well. I never discourage people from using social media, because I think you can get great ideas perhaps for investments, for trading platforms, for other products you want to use, but then you want to go that further step and validate, are the things that this person is saying and what I'm seeing in my social feed, does that make sense? And is it a good fit for me? Because it might be a good fit for somebody else, but maybe it's not a good fit for me.
Just kind of taking that extra step, not just listening, but also kind of taking the information, doing a little bit of background to make sure that that's kind of somebody that you want to be listening to that has kind of the credentials to back it up.
Absolutely.
All right. So this lesson's one that you also shared repeatedly on your podcast. So what can investors do to help validate what they hear online?
Reaching out, whether it's to individuals that they know, credible sources. It could be certain websites that are validated in terms of having credible information. We want to look for factual stuff. And so there's always a time and a place for opinion. Some influencers sometimes share their views, not because they're being paid or compensated, but they may be sharing their journey. And so we want to understand the difference there too. Is it someone's experience, or is it something that they've just picked up because they're being paid for it? And we need to think then about our goals, our time horizon, what our risk tolerance is, and think about, in my life, does it make sense? It may make sense for my friends, but I need to make sure it's good for me too.
Now, direct investing offers a ton of educational content and research for investors to consider as they validate what they hear online. So let's dive into our web broker platform for a quick overview. So this is a great place for you to be able to come to sort of vet some of the ideas that you are finding in other places like social media. So we can see there's kind of 4 main categories of content here, including video lessons, our learning paths, masterclasses, and webinars. Before we dive in there, let's just quickly scroll down and see there is a dashboard here that shows you all of the events that you are registered for upcoming. As we scroll down a bit further, we can see there's an overview of suggested topics, which are based on things that you have watched previously, as well as featured content that is available, as well as most popular now. So lots of content for you to kind of start from if you're looking for some information to vet some ideas. Also, I'll show you some of the areas you can go to find additional information. Under video lessons, I'm just going to go ahead and click on the filter on the right-hand side. I'm going to scroll here towards the bottom and choose video lessons only. And then what I have here is a whole host of video lessons on all different topics. If there's a topic in particular that I'd like to learn a little bit more about, I can simply click on filters and choose whatever it is that I'd like to see. So let's just say how the markets work, and I'll click to apply filters, and it's going to show me the only videos that actually match that particular topic. If I come back here, learning paths are relatively similar to video lessons. However, it's a bunch of lessons put together on a topic, so it can kind of take you from A to Z. So for example, if you're just getting started to invest, here's kind of 20 25 lessons to let you know what you would need to know, managing a portfolio, using options. So there are a ton of options there for that type of content. Our master classes are hosted typically 4 times per day on a whole host of topics, from the basic platform navigation to some more advanced topics like options trading, different investment types. So lots of content here, and they are hosted both morning, midday, and evening, as well as some Saturday classes. And finally, we have our webinars, which is, of course, what we are partaking in right now. These webinars are live events, of course, where you can have questions answered throughout the session. We also have a recording of previous events. So if you'd like to kind of come and watch one of the events that was hosted in the past, you absolutely can kind of filter through these different content here and find one that you're interested in and watch that content on demand. All right, the second lesson comes from YouTuber Rennie the Resource in episode 297. She said it's important for listeners to diversify their income streams. Now, she was talking about income sources in general, but why do you feel this is a key message for investors to take to heart?
Well, we've all heard the expression, don't put all of our eggs in one basket. And from that visual analogy, if we can think about it, having them all in one basket, they could rub together. If we trip, they can crash, and all of a sudden we're going to have no eggs left. And so we want to think about that across different asset classes as well. We want to be able to consider different geographies. We want to think about the risk profiles of different investments. And then we also want to think about what happens when those investments move together. Oftentimes, if we're being strategic about it, we can put different asset classes together and actually see the risk reduce because of the correlation between the returns. And so we want to make sure that we're being prudent about it. And 3 of the main categories we look at when we look at assets in a portfolio, we look at cash, fixed income like bonds, and then equities, which are stocks. And then we'd want to see, based on our goals, our time horizon, risk tolerance, how do all those come together in a way that makes sense for us to reach our goals without taking more risk than we want to.
Right. So they're acting in different ways. So if one's not doing so well, the other one might be kind of working to keep, highest potential return, lowest potential risk for kind of what our individual situation would be.
Absolutely. And so, like we've talked about, what might be suitable for my friend and their goals may not be suitable for me. And so each person should consider what it is that they're saving for, why they want to grow their portfolios, and what they're going to use it for, to make sure that they're into the right investments.
All right, so let's say an investor feels very strongly about the potential of one of their investments. What is the danger of kind of piling all their money into that one investment?
Lots of potential danger. So it depends how much they've researched it. So whether they have looked at the company, whether they've looked at their financial position, their plans for the future. Nobody has a crystal ball. So we may have an indication of what has been the historical performance for a particular investment, but we don't know, and nobody knows. And so the danger of putting all in one is that it's almost like gambling. It's potentially a speculation. And so we're placing a bet that it's going to do well. And we often cannot bear the consequence, though, if it does not go well. And so we want to make sure we have that diversification in our portfolio so that one particular investment does not bring down all of our investments and derails all of our financial plans. We want to be able to still rebound from that. We want our portfolio to continue to be sustained and still allow us to achieve all of the financial goals that we have, which really are tied to life goals. So if we're placing that bet, we're in risk of actually blowing up our whole financial situation and kind of wrecking all the plans that we had. So best to be diversified. And if you want to take people wanted to do a bet, or investors want to take a little bit of risk, carve out a small portion of their portfolio in order to do that. So still have control over their funds, still have control over the investment, but it's not going to jeopardize all of the life plans and financial plans that people have in mind.
Now, some investors might assume that a diversified portfolio, like we said, having those different asset classes, trying to lower some of the risk, would have middling investment returns over time. So what does the historical record say about that?
So typically we see that those who have a long-term strategy, who are holding for the long term, obviously revisiting their portfolios on a regular basis. So at a minimum, semi-annually or quarterly, but they're holding a strategy, they're generally going to see returns that are in excess of people who are doing a lot more active trading. And that has to do with people jumping in and out of the market, trying to time transactions. And they're also going to be paying less transaction fees. And so the long-term studies do suggest that having a longer-term plan and staying solid with it will generate higher returns.
The time in the market versus timing the market adage. And just a quick note to our audience. If you want to learn more about the benefits of long-term investing, catch our webinar with Dan Bortolotti from PWL Capital called Why I Believe It's Always a Good Time to Invest for the Long Term. It's available in the Learning Center on Webbroker and on TD's YouTube page. Let's move on to the next lesson on the list. So this one comes from the chat that you had with 3 of your students who are relatively new to investing. So Quentin, Mark, and Munir in episode 38. So they talked about the importance of keeping emotions out of investing decisions. So how can emotions work against an investor's best interests?
I love this topic, and certainly I see it all the time. And one of the courses I teach in my teaching career is behavioral finance. So we study why people do what they do. And so emotions can really cloud rational decision making. Everybody has them. Everyone is subject to some level of bias. And it can be that we're happy, we're sad, we're anxious, maybe we're feeling greedy that we've done so well and we want things to continue and we want to make a little bit more money. People might sell too quickly. People might jump into things they don't understand because they have that fear of missing out. So we can see erratic behavior happening when the rational decision making is gone. But when we start driving decisions with our feelings and our gut and our emotions, all of a sudden the rationality is taken away from it. And so no longer are we thinking about what are our goals? What was the reason we wanted to purchase this investment? How long did we plan to hold it? And we stop forgetting about all those things that led us to make the decisions in the first place and start having kind of knee-jerk reactions as the market moves around.
So what are some of the habits an investor can build to help them resist their emotions when investing?
If you want to have a little bit more accountability, it's helpful to have almost an investing buddy or somebody you check in with. So I was thinking about doing this. What do you think about that? And so you probably want to select someone that you know maybe is a little bit less emotional than you or will be that way about your situation. They may not be about their own, but they can definitely be less emotional when it comes to your situation. Maybe somebody who thinks about things differently so that you can get more diverse perspective into it and you're considering things from more angles. Because if you're getting this investing buddy who does things the exact same way you do, it may not be very helpful. So you want somebody who's going to challenge you and put you in check a little bit to do that. And it may be helpful to delay your decisions a little bit. Sometimes we do need to take action if there's a unique opportunity, but there's generally not a lot of things where we need to jump in and take decisive action in the next 5 minutes or something is not going to go our way. So to pause a little bit, let the emotions calm. If you have the ability to do so, sleep on it. In most things in life, I find after I get a good night's sleep, things are a lot clearer and I usually wake up with the kind of the decision in mind.
Yeah, just kind of having that, taking the urgency away, like the action urgency. Not that you're going to put it off forever, but at least give yourself a bit of time to really consider before you kind of move forward. Okay, that's a nice segue into the 4th lesson from personal finance educator and author Kelly Keene in episode 229. So understand your risk tolerance as an investor. So why is it so important in reaching our financial goals?
Well, we definitely want to know how we're going to feel as different things happen. So if the market's riding very high or if it's down in a low position, we want to know what is going to be our emotional reaction to that. So somebody who's really kind of risk averse doesn't want to get into something very high risk. That's not going to be the appropriate strategy for them. And so that may have been, if they got into that, then they might abandon the strategy halfway through, and then that's not going to allow them to actually hit their goals and achieve their plan. So consistency is really key. And so determining a strategy, and we would encourage investors to determine a strategy that fits for them, goals, values, time horizon, and risk tolerance all together to come up with something unique for them and not necessarily what someone else is doing, and kind of sticking with that, revisiting performance, making changes as needed, but not kind of throwing away the strategy wholesale just because there's a blip in the market or something's happening and it's hard to bear because your emotions are kind of driving that.
Interestingly, our risk tolerance can vary depending on our financial goals. Can you unpack that for us?
Generally, if you can think about what are the things I want in my life and work backwards, we can figure out, okay, how much would we need to start contributing now based on that time horizon and risk tolerance, and looking at different investment options to actually secure and have the money we need when that time comes. And not in a way that we need to get into the highest risk investments. We want to be realistic about how long it will take us to secure those funds and those gains to hit those goals. But we want to have a nice, consistent strategy that aligns with everything. But we probably will have some short, medium, and then long-term goals. And the goals are going to change. And so it's really appropriate to revisit your goals and make sure that the things that you're saving for and your financial plans geared around still make sense. If perhaps when you were first making your plan, you weren't sure if you might have a partner, if you would have children, people want to think about, if those life moments happen and fundamentally things change, what are going to be new goals that come into play, and ones that maybe fall away.
Right. And the idea is that you really want to have those savings goals as well, because those things like travel that you mentioned, and, maybe having a family or a wedding or whatever it could be, you want to make sure you are saving for those things and you're not defaulting on credit and having to pay it off over time, right? It's really important to have those things in your plan as well. So, yeah.
Some of the best advice I've heard from guests that we've had on the show, and I couldn't agree more. And I wish I listened to it more when I was younger, but you will always have a need for savings, and you may not know what it's for. So even if you don't have a specific goal in mind, saving is always beneficial, because there will be something that you want to do or you want to make happen. And having freedom and flexibility by having savings on hand will always be a benefit.
Excellent. Now, one of the points that you've made to your listeners is that they shouldn't be afraid to take calculated risks early in life. So what do you mean by that?
So certainly when we have time on our side, we can save less amounts of money. So even let's just say it's $25 a week or $50 a month, we can save smaller amounts of money. And if we're saving for retirement, for instance, we have a long time until we're going to retire. So we can actually grow that $25 a lot over the time horizon to get to retirement. And so we can actually take more risk on those investments, usually, because we're able to weather the fluctuations in the market. We can deal with it if it goes up or down, because it's a long-term savings plan for that strategy of retirement. So we can actually take a little bit more risk when we have time on our side. If we wait to start saving for retirement until we're older, we're going to have to contribute a lot more money. And some people may be tempted to get into higher risk investments because they've left it too long and now they need to make up the gains. But we can actually take a lot more risk when we're younger and not be so worried about if there are fluctuations in the market, because it's a longer term strategy.
Okay, on that note, WebBroker has a goal planning tool that can help investors create an investment plan based on their time frame and risk tolerance. So they can do this for major purchases, just saving in general, or retirement. So we can kind of apply it to all the different goals we talked about. So let's hop in and see how this one works. This is our home for creating our individualized goals. We're going to go ahead and click Get Started. And we have a choice to do different types of investment goals. So we could choose retirement, a major purchase, or just my money to grow. So let's choose money to grow. You can put in your current age here, the amount you'd like to have in the future, which is optional, or by a specific target age. Again, that's optional. And then we can go ahead and name our goal. I'm going to click Save and Continue here. Next, we're going to choose our investor profile. If we're familiar with investor profiles, we can go ahead and select whichever is most appropriate. If we're not as familiar, we can click View the Video, kind of see a little bit more information, or compare investor profiles to find out which one might be most appropriate. I'm going to go ahead and choose Moderate for today and click Save and Continue. I'm going to choose the accounts that I have that I'm going to use towards this goal. So I'm going to choose this tax-free savings for today. And then I can also input if I have any additional money elsewhere that I'm going to put into this account, and any regular contributions that I'd like to make. So I'm going to say I'll put in $50 bi-weekly and Save and Continue. So this is going to give me my projection of what my money is going to grow like until a future date. So we can see here that this is up until 2042. It's showing me how my money will grow over time. I can also make some changes here. So once I have this, if I say, you know what, maybe I'd like, if I'm 30, maybe I'd like to have this money by age 45. And maybe the amount that I'm looking for is, let's just say $75,000. If I click recalculate, it's going to show me that I am well short of my goal in order to hit that. So let's just go ahead and decrease that amount to something a little bit more realistic with that amount. So we're still a bit short. So what we can do is we can actually increase our contribution amount. So for example, I could say maybe I'm putting $75 biweekly, and then we can see that I get to my goal there and get a little closer. So I can manipulate these inputs here just to kind of make some changes and see how I could reach my goal. Once I click start with this plan, my dashboard will show this goal moving forward. So I'm going to have it here whenever I log into WebBroker. I can check and make sure whether I'm on track or not. And this will, of course, update as my portfolio value fluctuates. If I click view details, I can get in there and see that information again and make any changes as I see necessary. So this is a great tool to have in order to make sure that you are on track to meet your personal goals. Okay. The fifth and final lesson that we're going to discuss comes from financial journalist and author Erica Alini in episode 227, and it is a classic. She suggests automating the investing process as much as possible. So how might that help an investor reach their goal?
So the way we would want to do it is as soon as we get money coming in, which is usually in the form of a paycheck, we want to be able to put some of that money aside and pay ourselves first and direct it into some investments. So automatically doing that. To do that, though, we need to figure out how much money is coming in. What are all the bills that we need to pay from it? Because we certainly don't want to have it automatically deducted and then need to pull it back to cover some expenses that we have. So we want to be sure in terms of how much that is, but then we can have that move into the investments. And that allows people to really live within the money they have left over. Generally, investors do not miss it. And the key thing, though, is to stay connected with the reason that that money is being diverted. A lot of times, individuals and investors can get disconnected with the goal of it. And so remembering that that's for future them, and they're going to be able to go on that trip, or they're going to have that wedding or buy that house, have that retirement. And so staying connected to the goal is really important so that you don't just feel this money's gone off to somebody. It doesn't have anything to do with their lives. So really want to think about that.
Now, some people might feel as though they don't have much money left over to set aside for investing after each paycheck. Yet you've stressed that even a little something is better than nothing. Why is that?
Investors will hear people talk about compound interest. And what that means is money earns interest. And then as it continues to stay invested, it will be interest on not only the original sum, but then on the interest as well. And so the amount can actually grow significantly over time. And when you do have time on your side, that's a wonderful thing. So never discount even small amounts of money because it can grow to more over time. And a lot of people call compound interest as kind of the eighth wonder of the world.
And there's so many calculators out there too, where you can kind of say, if I put $25 away, how much is it going to be in the future, right? So those can be motivating as well to see how much your money is actually going to grow to on top of what you're putting in. So that could be another thing for kind of that putting it down on paper sort of thing and putting it in the vision of what it's going to be in the future so that you don't touch it now. For those in our audience who want to learn more about automating the investing process, check out our webinar, Ways to Automate Your Investing Approach with my colleague, Brian Rogers. You can find it in the Learning Center and on our YouTube page. All right, Tracey, we're going to have to leave our conversation there. Thank you so much for sharing some of the top lessons that you've learned from guests on your podcast. I'm sure it's been tremendously helpful for new investors just starting to find their way. Here's to another 300 episodes. Any final thoughts you'd like to share with our viewers?
Well, thank you so much for hosting me, Caitlin. It's been a pleasure, and really encourage everyone to take some action after listening today, whether it's getting a sense of how much money's coming in, how much money's going out. Maybe it's starting to research investments, but do one thing for yourself today as a result of what you've learned, and then make that commitment to do one thing actively every day. And most importantly, don't beat yourself up if things do not go as planned. Regroup. Everybody makes mistakes. And so be positive and keep taking those forward actions to build up your financial fitness.
I love your philosophy. That's so great. So positive. Okay, thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. We'll see y'all next time.